Andrew Balls, welcome. Something of an act to follow.
No, I think we should go straight to the coffee. I don't
We
see
go
how-
straight
I
to
don't
the
see
coffee.
How you follow that? That was
Well, there is a panel in between we've got to fit in somehow. I did wonder when Sir Ranulph was talking about the crevasse technique. You walk along, fall in, and then you know where it is. That's a little bit like running investments, isn't it?
yes. I think that's a reasonable amount of learning by doing and all of these things. No, I thought it was absolutely remarkable. I want to get a copy of the book. I thought that was slightly mad and very, very impressive. So,
Well, we'll hope we can keep one aside for you. Andrew Balls, of course, is the Chief Investment Officer for the global fixed income side of things at PIMCO. PIMCO, obviously, a firm which needs little introduction. Let's crack straight in, Andrew, to some of the questions that we've been thinking about. I'm going to quote you. Recent interview, I think Bloomberg, anyway, somewhere. You said, valuations look fair and in some cases rich. That feels like a little bit of a sort of understated way of approaching things. I want to ask you, is that just a variation of sell in May and go away?
So no, actually. So we at PIMCO, we have what we call our secular outlook. We have an investment horizon of 3 to 5 years, so a bit longer than sell in May and go away. And when we look out over the next 3 to 5 years, our best guess in terms of macro, in terms of markets, is more of the same in terms of where we've been for the past few years. But valuation for credit in fixed income space, for equities, clearly there's been a big move over the past year, and so we think it's time to be a bit more cautious in terms of our portfolios. If you go back to 2006, I think you had a similar period where valuations were quite tight. I mean, tighter than they are today. Back then, you could see a specific catalyst in the form of the US housing market. And we, at PIMCO, we became very, very defensive. I'd say in contrast today, it's hard to see clear catalysts for why you're going to see a shift in terms of the outlook. But current valuations, it makes sense to run less risk, we think, in our portfolios compared with most of the last 3, 4, 5 years, with valuation being an important part of that.
Andrew, if I may, you're still very, very gently being pessimistic. It was Reuters, I beg Reuters' pardon, not Bloomberg. You said here that you were talking here about the rising likelihood of a US recession. Let me ask you about that in another way. Obviously, the US Fed has just tightened. Expectations are very fluid over what might happen next, but there is a suggestion that's still reasonably current. There'll be a couple more tightenings this year. Let me ask you one very concrete question, though. Are you convinced that the next adjustment but one will be a tightening?
So
given that recessionary...
Yes. I think as convinced as you are about anything, so, you know, there's always possibility of events and surprises, but the Fed is going to start shrinking its balance sheet, probably announce this later this year. So there's tightening there. And then in terms of the Fed funds rate, our best guess is the Fed will get to about 2%. They may go again this year, they may not. Go a couple of times next year, 4 times next year, depending on what we get from fiscal policy in the US. That you don't see a lot of imbalances in the US, but in terms of thinking about recession risk, we are now 2008, we're now 2009, we're now about 8 years into this expansion. Post-war in the US, a typical expansion was about 8 years. This is a different period. It's been a post-crisis recovery. But going forward, the probability of recession over the next 3 to 5 years is, going to be reasonably high in the US. We know what happens to credit markets in recessions. So again, the probability of recession over 3 to 5 years, pretty high.
Just because it hasn't happened. You're a determinist.
Just arithmetically, the risk is growing higher. In the European case, a few years further behind. In the US case, they probably have the tools to deal with the recession. It could be a mild recession. In the European case, arguably more worrying if we were to get to that in terms of European sovereign dynamics.
Okay, so we get to this new neutral, which I think is actually a copyrighted PIMCO term, isn't it?
It may well be.
You've registered the new neutral, so nobody's allowed to say new neutral unless you get permission from PIMCO.
There we go.
We get to the new neutral of about 3%.
2%.
2%.
So about 2%, 2 to 3%, I guess. But if you think the real neutral rate for the US central bank is about 0, and if you assume that they'll probably get to about 2% inflation, 2%, and if you're a bit more optimistic, 2.5%. When we first started talking about the new neutral in 2014, the markets are pricing in a terminal rate for the Fed above 4. Now it's priced in. The market's priced in, below, call it 1.5%, 1.75 for the Fed funds rate. So that's priced in. The important thing is that means that's anchoring, we think, for fixed income valuations. If you thought the Fed was going to get to 4.75, which again would have been more typical the 30 years before 2008 in terms of the terminal point, or the neutral point, I should say, then that would be very destabilizing for global fixed income markets. If you think they get to 2%, or in your case they don't even get there, then that helps to explain why we can have stability at low levels for interest rates. And you can do the same for other...
I love the idea of a terminal rate.
Where they finish hiking.
There's a famous emerging markets investor who was on this stage last year, in fact, known for saying that emerging markets don't really exist. There are just places where you get paid for taking risk and places where you don't. Do you agree with that philosophy, that idea? And how does it play into your thoughts about Italy? Because your thoughts about Italy recently published are somewhat bearish too, it's fair to say.
Yes, so I think it's right to say that looking at emerging markets as an asset class doesn't make a great deal of sense. You have a wide range of countries, different instruments that securities you may invest in. So yes, I think you have to go country by country and place by place. And Italy, other European sovereigns, there's certainly characteristics of emerging markets, maybe submerging markets, when you don't borrow in your own currency. So the UK borrows in its own currency, the US, Japan, an interesting case, but Japan. And then you have a case like Italy, where it's not clear that you are borrowing in your own currency. This is what got us to yield spreads of about 800 basis points over bonds in 2012. The uncertainty about whether you could actually be forced into default in a way that's not likely, and in some ways not possible to be forced into default when you have your own currency. In the Italian case now, yields are just about 2%, spreads about just below 170. From our point of view, you need to be very generous to want to fund Italy for 10 years at 2%, given the wide range of risks in that country. There's an election coming probably next year now, not this year. In the first round of the Italian election, as happened in France, 50% of the Italian voters are likely to vote for explicitly anti-EU parties, anti-Euro parties. And in the event of a another sovereign crisis in Italy, if it's not going to be the European Central Bank, which provides stability, it's going to be a program, ESM and the Troika. It seems like a good bet that the strike price there is not going to be 165 over for the 10-year Italian bond. So if you don't get paid to take the risk in Italy, don't take it there. But you can, I think, find some very good opportunities in emerging markets.
Are you lending money for a century to Argentina at 8%?
No, I mean, that's certainly interesting. Another
eye-catching trade.
Another sign of the times. So it's not something that we participated in. We did actually do an earlier Argentine issue, but again, if somebody with a 100-year bond, a lot of the value obviously comes in the first 30 years. But if you have the confidence to be able to look out over 30 years in Argentina and determine that's a good price, then you're smarter than we are at
21.17. It's quite a remarkable thing to chew over, isn't it? There'll be a global borrowers at the Hilton Hotel, Park Lane, June 21.17. There's a couple of things I want. One thing I want to talk briefly about the firm itself, and then I've got the sort of conceptual question I want to ask you too. So let's turn to PIMCO just for a second. It's fair to say that the family feud, the disagreement among some of the leading personalities there was pretty well publicised in recent months and years. Now, obviously, we see that as now a resolved situation. Clearly some people have moved around, but other than people moving around, is the firm going to show a different strategy or a different investment style? Is there anything that we can look to be a new PIMCO other than the names on the doors?
That's interesting. So I joined PIMCO in 2006, and I knew there was going to be a transition, and I thought at the time, this will be an interesting time to be at the firm. It proved to be more interesting than I was expecting. But in terms of the investment process, it's a bit boring, but there's no change in terms of our investment process, given the departure of the founder of the firm. As an investor, you're always as good as your track record, and we're coming up to 3 years since that transition. Performance has been good across a wide range of our portfolios. So in terms of the stability of the firm and the investment process, nothing much changes. A few things changed on the marketing side, I guess. So those guys have had to work hard. But I mentioned our secular forum. We've just had our secular forum. We've been doing this for close to 40 years. Things proceed the same as before. You always make incremental changes in what you're doing. You can always find ways to do things better. But the team.
Secular is a key bit of PIMCO vocab. What does it mean in PIMCO?
So an outlook for 3 to 5 years. We're not smart enough to tell you what's going to happen over 3 to 5 days, but we think if we take long-term investment decisions based upon a medium-term outlook, then that can help guide us in the right direction.
Okay. Let's pull out then from the firm to the industry as a whole. Sitting in that chair tomorrow is going to be, I guess, sort of your counterpart from Vanguard. Now, I'm not going to ask the obvious question about Vanguard, but I would like to ask you just if you see programmatic or index investing in general as the asset management sector's Industry 4.0 moment.
So from our point of view, indexing makes sense on the equity side of the equation. There's reasonable evidence it's hard to add value in terms of active management in equities. It's more of a zero-sum game. And again, in our view, you should not then translate this to fixed income, where the dynamics are quite different. So you have a lot of participants in fixed income markets who are not fund managers. So people who need to hedge interest rate risk, people who need to trade, and so therefore hedge currency risk. You have a larger and growing proportion of fixed income markets which are not profit maximizing investors. You know, the official sector is more and more important in the market. So we stand by our track record. We have a long track record for generating alpha for our clients. But you know, Jamil Bars, one of our senior analytics team members, put out a recent paper on the whole of the industry in terms of fixed income, and over time in fixed income markets, our view is that the active managers collectively can add value for their clients. In contrast to equities, where my gain is your loss, more of a zero-sum game,
So bonds are different.
So bonds are different. I should. The previous speaker selling the books. I should have brought the document to hand out afterwards. But Jamil Bars wrote a piece. I think it was called "Bonds Are."
Bonds are different. The active advantage.
And we think you can see it in the data.
Okay.
The other thing I should just say is bond markets, market cap indices are rewards for failure. So the more Italy and Japan issues, the bigger they are in the index. On the equity side, the indices are not perfect, but at least the FANG's growing. At least it's reward for success rather than the case to fixed income reward for failure. So people who had, say, in the European case, if you had a passive investment in safe European government bonds in 2009, you probably ended up having a lot more excitement over the next few years than you really had set out for. Big benefit for.
And we don't have time to talk about sterling and the end of austerity, which the end of austerity presumably means spending money like a sailor on crack rather than just a drunken sailor, £100,000 a minute borrowing. I want to ask you something else about a much bigger picture, though, in 2 minutes or less. Uber, right? You're a Californian company. You must have noticed Uber and Uberization. There's a lot of people saying that amid all the political debates of recent months and years, how little attention gets paid by the political caste to the fact that our children's jobs haven't been invented yet. Do you know the French philosopher Bernard Stiegler, who has this tag, l'emploi est mort, vive le travail?
Okay.
Do you agree with that? And is there a room full of boffins in Newport Beach working out what technology and the erosion and destruction of typical ways of people being employed means for investing?
So the first question, yes, I would definitely agree with that. There's a concept in economics which is called the lump of labor fallacy, and the assumption is there's only a certain amount of jobs, a set number of jobs, and so a lump of labor. And this is probably what motivated the French in the 36-hour week type approach, and it's madness. If you went back 60 years in the UK and looked at how many people worked on farms compared with today, there weren't a lot of radiologists in 1945, and people definitely, our children will work in jobs which don't exist today. So the lump of labor fallacy is bizarre how motivating it is in political discourse, but it's a fallacy. In the case of PIMCO, two obvious things. The first thing is, if you look globally, it's hard to find evidence of much wage inflation pretty much anywhere in the world. Phillips curves are flat in the US, in Germany, so on and so forth in this country as well. I think the second thing which is important and something we have a lot of people working on is at a place like PIMCO, and I'd have thought most similar places, we will do more and more automation in terms of the trading that we do, algorithmic type approaches, and that's something which has become more and more will become the industry standard. So that's an area where we've invested a lot just to get the best execution. You know, there are cases where machines will do better than human beings in trading.
There's even an employment question for asset managers. Even active asset managers.
So the interesting thing is we did a big study actually, our traders versus the algo, and there are times when the algorithm does better and there's times when the traders do better. So there's hope yet. And then finally, it's not my area, but I think robo-advisors and that kind of thing for small investors, you can pay a lot for a very smart private bank, some of them up there, and you can pay a little for robo-advisors in terms of individual asset allocation. And you know, I'm sure there's lots of benefits that the private banks bring to bear, but simple robo-advisor type approaches seem like a very powerful thing.
Alexa, what bond should I buy today?
Well, Alexa, you know, I'm 30 years old, how should I have my asset allocation if I want to retire when I'm 65 kind of thing. And I think that's, you've seen some growth there, but I think that's something which is probably a real positive in terms of making financial advice available, you know, without the white gloves and the high quality coffee, but the underlying data being very helpful in terms of helping people with their individual planning.
Very good. Andrew, thank you very much indeed. I hope I still get a cup of coffee though, at least when I come to Newport Beach. Thank you very much for joining us, for answering those questions. We will hope to see you again at another Euromoney conference in the future.
Well, thank you for having me. Thanks very much.
Thanks very much indeed.